Hi, I'm Dongshang. Welcome to Digging into China, where we explore China in depth to review unique perspectives. Today, we are going to examine the financial state of the Chinese Communist Party and determine the true limit of the Chinese government's debt, where the ceiling on the CCP's borrowing lies, and in what year the CCP might face insolvency. First, let's consider the time frame. In essence, how long can an economy endure the squandering and the misallocation of its resources? China's economy can still manage to stumble forward for now, and the reason is straightforward. Households and the private sector are bearing the cost of the CCP and Xi Jinping's mismanagement of economic resources. The CCP holds a monopoly over all of China's core means of production. The more fundamental the resource, the tighter their control. Essentials like coal, banking, water, electricity, and land are firmly in the CCP's grasp, giving them the authority to dictate the pricing of society's basic inputs. These critical resources are the lifeline of businesses. By arbitrarily inflating their prices, the CCP can manipulate the private companies' behavior at the economy's foundation. On top of that, they impose a maze of administrative obstacles. This requires approval that needs an official signature. Frankly, anyone running a business in China deserves commendation. Operating a factory means navigating at least 100 bureaucratic steps. Even local neighborhood authorities can make life unbearable for a company if they choose to target it. Why is Xi Jinping's economic strategy destined to fail? His policy pretends to foster competition between state-owned enterprises and private firms. Is that realistic? State-owned enterprises are backed by the CCP's coercive power, while private firms have little behind them, perhaps at best a well-placed official offering support. Why do Xi Jinping's efforts to encourage the private sector inevitably fall short? The CCP's state-owned enterprises are an odd hybrid, neither fully governmental nor truly corporate, neither market-driven nor independent. Consider a clear example. Many state-owned enterprises, such as the major management consulting firms in financial services, could even the most well-funded private company compete in their domain? Not at all. These firms benefit from numerous government-granted special policies. What are these so-called special policies? In essence, they are privileges that allow state-owned enterprises to bypass competitive rules. Expecting them to compete fairly with private firms would mean either provoking these privileges, allowing them to retain but not use them, or extending identical privileges to every private company. Without any of these, how can the private sector possibly compete on equal terms with the state-owned enterprises? If the fairness touted by the CCP remains government-controlled, then regrettably, any fairness not rooted in market principles is mere pretense. Xi Jinping's understanding may only extend to believing that permitting a business to operate is fairness enough. Yet he fails to recognize that his very presence is the source of the inequality. History and the current experience of the Chinese people underscore one truth. The dominance of state-owned enterprise is the root of economic disaster. Their privileged status is the fundamental cause of economic calamity, driven by one factor, the distortion of resources under the weight of power. With this understanding, we can reframe the issue. The private sector's capacity to generate value sets the ceiling for China's debt. The real economy isn't what the CCP's media portrays, that entrepreneurs owe their existence to the CCP's China. In reality, China's private enterprises sustain 80% of the nation's jobs and prop up the CCP's state-owned enterprises. Beyond that, they even support the CCP itself. For the first 30 years of CCP rule, a planned economy with no private sector brought the national economy to the edge of collapse, as even CCP's own history text acknowledged on the eve of reform and opening up. With this logic established, let's revisit China's debt ceiling. It becomes simpler to construct a basic model. We are looking at the dynamic boundary between the private sector's economic contributions and China's debt growth rate. More precisely, when the private sector's share of the economy falls too low, the misallocation of resources triggers economic collapse. We can analyze this data from various perspectives. For example, the share of private sector financing in total social financing, the private sector's overall proportion of the Chinese economy, or a comparison of the private sector's contraction rate against China's debt growth rate. This approach reveals the extent of China's economic decline and clarifies its debt ceiling. The next question is simpler. By understanding the degree to which the private sector's economic share is shrinking and the trajectory of China's debt growth, we can calculate a linear relationship between the two. This reveals the rate at which China's debt expands as the private sector contracts. Using international benchmarks, we can then evaluate China's debt limits. The key measure of debt levels is the ratio of total debt interest to government revenue, a standard used globally. China's government collects about 20 trillion yuan in annual revenue. When debt interest surpasses 10 trillion yuan, it signals an economy on the brink, as it exceeds 50%. At that stage, China's debt will have crossed the threshold of collapse. One might argue, couldn't they just lower interest rates to zero to keep that interest below that ratio? If rates fell to zero, the yuan's exchange rate would collapse, sparking massive imported inflation. That would lead to social unrest, a different scenario entirely. This explains the CCP's current policy disarray. They aim to sustain exports while also stabilizing the yuan's exchange rate, an approach that essentially uses the private sector's hard-earned foreign exchange to subsidize the capital account. By refusing to revalue the yuan, the CCP is hemorrhaging foreign exchange reserves. Treasury yields and commercial bank loan rates are already at rock bottom. Further reduction in bank loan rates would cause the banking system to implode. The current interest rate spread is barely enough to keep banks operational. If loan rates drop more, the Ministry of Finance would need to inject funds to maintain banks' core capital. Thus, the cost of additional rate cuts continues to climb. That's why, despite endless discussions and meetings on economic challenges, the CCP keeps arriving at the same conclusion: they are out of solutions. Ultimately, the CCP recognized the private sector's importance, but Xi Jinping's brand of political correctness poses a barrier. This political stance is sacrosanct for Xi. Questioning the state-owned economy's primacy would undermine the legitimacy of his leadership. That's why even forums meant to promote the private sector must emphasize the vital role of state-owned enterprises. Last year, even Hu Xijin, a longtime CCP mouthpiece, was silenced for overemphasizing the private sector's economic significance and overinterpreting Xi's remarks on reform at the third plenum, delayed by 10 months. By elevating the private sector's political standing, Hu challenged Xi's untouchable political narrative. Highlighting the private sector's role was seen as opposing Xi's authority over economic policy, a line no one, not even Hu Xijin, can cross. If we estimate China's debt at 148.5 trillion yuan, the breakdown is approximately central government debt at 42.5 trillion yuan, local government debt at 46 trillion yuan, and the local government financing platforms at 60 trillion yuan, totaling 148.5 trillion yuan. Now let's examine the link between the private sector's declining share of the economy and China's debt growth. A clear trend emerges. Since 2018 or 2019, the private sector's economic contribution has fallen from a peak of 61% to 48.5% last year, with a projected 46% this year. Conversely, the government debt to GDP ratio has surged from 56.7% in 2018 to 93.8% today, a 50% increase in under 7 years. That's Xi Jinping's remarkable feat. The government debt growth over the past 7 years equals the total debt accumulated in the 30 years prior to 2018. This illustrates the scale of Xi's economic disruption. The linear correlation between these trends is striking. By plotting the data as trend lines and scatter plots, we calculate a correlation coefficient of negative 0.972%. In statistics, a coefficient above 0.8% signals a strong positive correlation, while below negative 0.8% indicates a strong negative correlation. A negative 0.972% reflects an absolute negative correlation, meaning that as the private sector's share declines, the CCP's debt ratio rises. The linear regression equation shows that for every 1% drop in the private sector's contribution, the government's fiscal deficit ratio increased by 3%. The private sector's share can decline in 3 ways. The private sector itself shrinks. State-owned enterprise investments grow, diluting the private sector's proportion, or both occur simultaneously. The private sector contracts while the state-owned sector expands. China currently faces this third scenario, meaning the private sector's economic contribution is likely to decline even faster moving forward. Why? In the first quarter of 2025, non-tax revenue jumped by 10%. Industrial and residential electricity and water prices are set to keep rising. If you are a business owner, would you continue operating or investing? Can society expect any growth in private sector investment? If we project the linear rate of change, China's fiscal system could collapse entirely within a decade. But let's assume the private sector's contribution declines steadily, not at an accelerating pace, a generous concession to the CCP, the most optimistic scenario. Even then, China's fiscal outlook barely improves. The subsequent calculations are straightforward. As the private sector's contribution rate falls, we determine when debt interest exceeds 50% of fiscal revenue. Typically, debt interest below 10% of fiscal revenue is low risk, manageable, where most developed nations sit. At 20%, it's medium risk, with repayment pressures emerging and fiscal flexibility waning. The US is nearing 20%. At 30%, it's high risk, with fiscal space severely constrained and the governments risk a cycle of borrowing to repay old debts. Above 30% is extreme risk. The fiscal system is consumed by interest, approaching or entering collapse. Using 50% as our benchmark today is, once again, a generous assumption for the CCP, the ideal case. The Soviet Union and the Eastern Bloc collapsed at around 40%. We have key data points. China's total debt stands at 148 trillion yuan. Annual fiscal revenue is roughly 21 trillion yuan. The relationship between the private sector's declining share and the fiscal deficit ratio shows a 1% drop in private sector contribution raises the fiscal deficit by 3%. China's reported GDP is 134 trillion yuan. This also highlights that the private sector's investment efficiency is 3 times that of government investment. Thus, the greater the private sector's economic share, the stronger the currency's value. Conversely, as the share of state-owned enterprises and the government ideology rises, the currency's value should fall. If we calculate China's total debt interest at a 3% rate, an average, since central government debt interest is below 3%, but the local government financing platform debt exceeds 3%. Otherwise, there will be no need for central debt swaps. Then the overall borrowing rates is likely around 3%, with little variation. As China's government debt and interest burden grow, when will interest reach 50% of total fiscal revenue? Between 2038 and 2040, assuming a 1.25% annual growth in central government revenue. Using the Soviet Union's threshold collapse at 40% debt interest to fiscal revenue, the CCP would face collapse between 2034 and 2036. Consider a household. If 40% or 50% of monthly income goes to bank interest, can they carry on? Of course not. The debt doesn't shrink, and they are trapped in perpetual borrowing. Some CCP supporters might claim internal debt isn't real debt, just print more money. But unrestrained money printing sparks hyperinflation. If hyperinflation erupts in China, the fallout would extend far beyond economic decline, triggering a comprehensive crisis of social order and political stability. First, living costs would spiral, with prices soaring. Essentials like food, fuel, and housing could double or rise tenfold rapidly, devastating ordinary people's life. Second, saving would evaporate, and the middle class would collapse. The deposits and the pensions of China's hundreds of millions of middle-class citizens would become worthless. Wealth accumulated over generations could vanish overnight. Third, businesses would fail and unemployment would surge. Even large state-owned enterprises could falter as demand shrinks and financing costs climb. A massive unemployment wave would hit, particularly in manufacturing and service-heavy coastal regions. Fourth, food security risk would intensify. China already faces declining food self-efficiency. Hyperinflation would drive up imported food costs, while domestic agriculture would struggle with rising prices for fertilizers and seeds. Urban residents might face food shortages, and rural areas could cut output as profits dwindle, raising the specter of famine. Fifth, the currency's credibility would collapse, deepening international isolation. A yuan undermined by hyperinflation would paralyze domestic economic cycles and cripple international trade. Foreign investors would exit, and the yuan's global aspirations would halt. With the US-China decoupling already limiting key export markets, hyperinflation would further erode China's trade capacity, leading to economic isolation. This, of course, is just one perspective, a projection based on statistical models, offered for your consideration. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, be well.